NatureAlpha is a data and analytics company. It provides information. It's focused on investors and decision makers for companies and then for assets. What are the different drivers of risks that are related to that asset being in a specific location or within a specific value chain with respect to nature? You actually need to have a dashboard approach to how you measure not just the performance of companies, but also around the types of products that you're offering, depending on what your client, who's the asset owner, ultimately wants to accomplish. And there's going to have to be multiple ways to do this. Initially, I thought, okay, carbon prices are a necessary and sufficient condition for this to happen. Then around 10 years ago, I started thinking maybe they're necessary, but not sufficient. And now I'm not even sure they're the necessary point. Maybe there's other routes that we should think about, but I am convinced that the solution has to be political as well. There's been an inquisition in the Catholic Church where ideas that were a little bit different and were punished severely. That's what happens in economics departments today.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. Laura, thanks for coming on the show with me today.
Thanks for having me. It's a pleasure.
I always start with something personal because I think it puts everything else that we're going to be talking about in context. You grew up in Padua, Italy. So take me back to your childhood. What was your environment like at home, and how did your family's approach to life shape your worldview and the way you think about risk and opportunity to this very day?
So I did grow up in Padua, Italy. It's an old city, not far from Venice in the northeast part of the country. I think one of the most interesting and important things about Padua, it has a very old university. It was the second oldest in Italy. It was founded by a group of sort of breakaway students and professors from Bologna. And the first graduates, the University of Padua, graduated in 1222. So we just celebrated the 800th anniversary. I know it's a long time.
Not too many people showed up. Huh?
Not too many people showed up. That's right. So it has a long and storied sort of academic. There's an atmosphere in Padua, which is very academic and very intellectual. And my parents came there as students and then they settled in. That's where I grew up, I would say. So my dad, he's an engineer by training, and he worked at the Italian power company for his entire career. My mom was a teacher. She's retired also. She has a background in art history. When she retired from teaching, she pursued more of her passion, more full-time in research. Although she started out as a medieval historian, she's now working more on contemporary Italian history, in particular between the two wars and the end of the Second World War and the sort of the formation of the Italian state. So I was very influenced, I would say, by these two souls within my house, which is one is more like scientific and engineering focused. And my dad, every road trip that we would take, he would point out at every single transmission line and tell us, oh, this is a 240 kilovolts, explaining to us all the mechanics of how power plants operate, etc. And then my mom, who actually gave us much more of the art and history. So that was interesting. I think the second aspect that was interesting about my parents and the household that I grew in is that both my parents were Catholic, but sort of the Catholicism that is very social justice focused. And so for me, growing up that way, I just had a very keen sense of justice and injustice that also shaped a lot of how I think about issues in my career or in my personal life.
You had what you call a classical Italian education, not being schooled at all in Italy. What does that mean?
So when you go to high school in Italy, there's a bit of a hierarchy of different sort of types of high schools. There's two types. One is more STEM focused and one is more focused on classics. It's where you study Latin and Greek for 5 years. And so it's a very sort of traditional Western classical education. And so I took that path. And it was amazing because although you don't really realize that when you're a teenager, to be honest, because you don't really care that much about that stuff, it's fantastic foundation to have to really understand so much about the world we live in and societal and cultural issues. And so I'm so grateful that I had that because when I went to university, I studied economics, moved towards a bit of a different discipline, actually more quantitative, obviously social sciences, but having that foundation of Greek, Latin, philosophy, philosophy and history and even languages and understanding the cultural foundation of Western civilization. That was just an incredible opportunity that now, today, I'm just very glad had.
In 1997, you entered the Università di Padova to study economics. Why that university? Why economics? And what did you think you wanted to do with your life?
So I had a lot of interest growing up, as you probably can understand from the classics. I could have gone to history, or I could have gone and studied political science. I really wanted to study law. My parents really dissuaded me from that. Maybe they thought that it would be a little bit constraining for me, like from a career perspective, and maybe not open up as many doors internationally, as they knew that I really wanted to explore opportunities outside of the country. And in Italy, you basically have to choose a major or choose what you're studying when you go to university. It's not like here in the US where you go to school and then you sort of try out a few things and then you declare majors. So I went into economics because it felt it was something that was broad enough. And then when I went into economics, and I picked the University of Padova because it just offered a lot of opportunities for international experiences, which is actually what I did when I was in school. I did 2 years in Padova, and then I did my third year in the UK. I studied in Wales for a year, and then I studied 1 year, the last year, at UC Berkeley. So that was my first time in the US, and that encounter with the American academic world and also sort of economics departments in the US. So when I first went into it, I thought maybe I'll do something that's closer to a business curriculum. But then while I was in it, I really enjoyed the political economy aspect of it, not surprisingly, because I'm always very interested in the politics of stuff. I explored different things, and I ended up enjoying it, actually. I ended up enjoying studying economics. But to be honest, Scott, I think that you can put me pretty much on anything and I'll enjoy it. I just enjoy learning.
So you entered in economics, and in your first undergraduate macroeconomics class, you were inspired by a guest speaker. So tell me that story.
So this was my first macroeconomics class. I believe it was probably my first year of college. And the professor who was teaching this class, his name is Benedetto Gui. He's a really interesting guy because he's done a lot of work later in his career about the economics of communion. He invited a guest speaker one day, and this person came in and he talked about something that as a first year economics student, you don't really necessarily have the means to understand. But he talked about the fact that GDP, so gross domestic product, as a measure of wealth, as a measure of well-being of a country, is a flawed metric because of a bunch of reasons, and because it counts certain things, but it doesn't count other things. His argument was that one of the things that GDP doesn't count is that it doesn't count environmental devastation that comes from the production of wealth. And so his argument was we actually need to account for that in this metric. He advocated for introducing a different metric that's called the green GDP. And for me, that was a light bulb moment. And I started, I think, understanding a lot of the limitations around traditional orthodox economics thinking. And it sort of got me on this path of studying economics, but in a bit of a different way. And I did a lot of work, and that's what I did also when I was in Toulouse, etc., on some of the inefficiencies of markets, you could say. So obviously externality is a big thing when you talk about environmental issues, but also information asymmetries and agency theories, principal agents theories, etc. That's the thing that I found really interesting in my economic studies when I went to graduate school. That's really the core of what I explored when I studied, in particular, industrial organization, which is about how markets are organized.
2003, you're off to France.
Yes.
To study for a master's in industrial economics at the Toulouse School of Economics. While, if I got this right, concurrently, you were also pursuing a PhD in energy studies back at the Università di Padova. How did that come about? And what was driving your focus towards the intersection of economics and energy systems way back then?
So I mentioned that my fourth year, my senior year of university, undergrad, I spent at University of California, Berkeley. And what happened that year was quite interesting. Among the many things that happened, the Bush-Gore election and a bunch of other stuff. But one of the things that happened was that California experienced quite significant power blackouts that were not necessarily driven by weather events like you could see today. It wasn't some failure of a power plant. It was really a flaw of market design. The incentives were wrong, going back to incentives, which is sort of what I studied also in the Toulouse school. But the incentives were wrong and the market design was wrong. And then the Enron case happened. So that's another exciting thing that happened that year. The dot-com bubble happened. A lot of stuff happened. But this is the thing that caught my attention because what's more tangible than not having power? I think it drove home to me a few things. The importance of some specific industries, power being one of them, the energy system being one of them. It's just so vital. It's the backbone of everything that we do. And so I thought, that's an interesting thing to study. But also how a certain political approach to thinking about how those industries should be organized has really influenced the lived experience of people. That was really exciting and really interesting. And it sort of encouraged me to study that aspect a little bit better. It also helped that my father had a long career in the power sector. And by the way, similar regulatory or deregulation efforts were happening in Europe at the time that had a significant influence in how the market shaped up afterwards. And I decided to pursue that. So I went into a PhD in Padova. My advisor, his name is Arturo Lorenzoni. He was affiliated with a research center at Bocconi, where I also worked, the Center for Energy, Institute for Energy Economics. And he brought me in and I started doing work with him. And there was this PhD program in energy studies that was fairly open in terms of what you could focus on. It was within an electrical engineering department. So all my other fellow colleagues at the time were all electrical engineers and working on very cool, interesting stuff. And I took more the applied economics track. And so I did this work with him that really combined the engineering aspect. And I had to learn a lot, obviously, about power system engineering, which I think is great because when we talk about power and climate, etc., I understand this way better than most people in the room. So I started that PhD, but there wasn't a lot of structure around that PhD program. And so I decided to go to Toulouse to do a master's program for 1 year where I would get some of those foundations in terms of graduate economics and some of the industrial organization stuff that Toulouse is really good at under Jean Tirole, all this theories of incentives and market regulation and market design, etc. So I got that from Toulouse while I pursued the PhD in Padova under Arturo.
Eventually, you got your PhD, and then you made a series of moves that seem quite deliberate in retrospect, but you went from doing research at, you mentioned the Università Bocconi, to being a research economist at the Électricité de France, to doing climate philanthropy and policy work as a senior economist at Climate Works Foundation, and then on to contributing to the Paris Agreement in a role at the Decarbonization Pathways Project at Columbia. So walk me through that progression and hit on any of the highlights that you think are relevant to where you are today.
I think it's a really interesting path, and some of it was deliberate and some of it also happened because life happened. So my first job out of my PhD, that was a very deliberate thing. I did a short internship at the European Commission, and through some of the relationships that I created there, I landed an interview at Électricité de France, which is the French former national monopoly in the power sector. Also a very interesting company because for two reasons. The first is that it's a bit of an outlier in the ecosystem of power companies around the world because it has a very significant nuclear fleet. And that was a choice that France made in the 70s. And I thought it was really interesting to actually also explore some of that culturally. And then the second is that it has a very long tradition of having economists and engineers work side by side and really sort of understanding a lot of the intricacies of what it means to be a power company, but not just from an engineering perspective, which was maybe a little bit more traditional when these were natural monopolies that were regulated within countries, but also really understanding the economics of it. And it was Marcel Boiteau, who was a longtime CEO of the company, who really brought this approach in it. So I thought it was super interesting. I got this interview and I got the job and I moved to Paris. I started this job and it was really interesting because, of course, I started working in these teams that were mixed teams, a lot of engineers, a lot of economists, and really thinking about what are the issues that power companies, certainly in Europe or globally, have to really think about now. How do they think about investment decisions? What's influencing their investment decisions? There's a significant thing or two significant things that are affecting those decisions. The first was the regulatory environment. And that was, as I mentioned just a little earlier today, that was shifting quite dramatically. It was really changing and transforming quite a lot. And so that affected how companies thought about their role and their business model and what they should be focusing on, et cetera. And the second was also obviously technologies and how technology costs were changing. For example, the early 2000s was a time when there was a lot of expansion of gas power plants in Europe, but also the economics of renewables was becoming quite compelling, although it was early days. And the amount of new nuclear power plants that were being built was significantly shrinking. So it was very much a difference of technological environment versus 20 years earlier, 30 years earlier when EDF became what it was. And so it was just really interesting time to be within a company, applying a lot of the stuff that I had thought about for a number of years. And it was a fantastic experience. And that was at the time when another type of regulatory intervention came onto the scene, and it was the European Trading Scheme. And so it's this idea that carbon becomes constrained resource. Europe had decided that it was going to institute a market to allocate efficiently that carbon resource, and power sector was one of the first ones to be included into that carbon trading scheme. And so obviously for EDF, that was not necessarily a big cost consideration because of the large nuclear plan, but it certainly changed the way that the company viewed itself with respect to the other companies that had significant more limitations. Think about the German power companies that had a very large coal fleet at the time, or even think about some of the Italian ones, a lot of some coal, some oil, but also a lot of gas, versus a company like EDF who had a lot of nuclear. And so that was really an interesting way to connect the stuff that I had worked on and studied so deeply, economics of power systems, with this new consideration that was around climate change and how that affects this industry, which still today drives a very significant amount of emissions.
That work on the carbon markets you were doing in what organization?
At EDF, at Électricité de France. That's when it started off. Yeah.
Then climate philanthropy policy work at Climate Works, and then ultimately ended up on the Paris Agreement and another project. So make some sense out of all this.
Make some sense out of your story. Yes. So basically what happened was I worked at EDF for a few years. I moved to the US because of personal reasons at the time, and I moved to California. And I worked for a short amount of time at a think tank where I think it's the first foray into another topic that we'll talk about later, into another sort of area that became interesting to me, which is the role of capital markets and finance in all this puzzle that we're looking at. And so I worked at the Milken Institute for a few months, and then I actually got a job at ClimateWorks Foundation in San Francisco. And ClimateWorks Foundation was such an interesting place because it was founded by Hal Harvey, who had also started the Energy Foundation, which was a US focused foundation with a very large endowment, but it's like a very initial outlay from the other foundations. One was the Hewlett Foundation, one was the Packard Foundation, and one was the McKnight Foundation. And Hal managed to get these foundations to give him about $1 billion, a little bit over $1 billion actually, to seed this new foundation, ClimateWorks, that was going to be focused on a specific mission, which was go after the highest mitigation opportunities, so emissions reduction opportunities across the world, but with a very scientific approach around, it was sort of like a matrix approach around region and sector. So it was a bunch of sectors, say power, transportation, buildings, etc., in a lot of different regions of the world that drive a lot of the emissions, like Europe, China, India, the US, Latin America, etc. And it would fund teams that would advocate for policy change that could drive emissions down in those sort of cells of the matrix. So it was a very interesting, very deliberate approach about how to do philanthropy. And it had also a very important, in a sense, easy to track metric around success, which was what are the policies that are passed and how much emissions reductions are we getting from those policies? Like, what is the yield in terms of emissions reductions? And so we would track that. And Hal hired me into his team. He was the CEO. He hired me into this little team that he had formed that helped him out. And in particular around these ideas of like, how do we frame the plan of the organization and how do we track the impact of the organization? And then like a bunch of special projects that are also kind of interesting. We wrote these papers for Bill Gates at the time to convince him that climate was a worthy endeavor for him from a philanthropic perspective, convincing him about some of the policy changes that are needed. So we wrote these papers that are called Policies That Work. And it was like really interesting work. And then we did a lot of work with multilateral development organizations like the World Bank, for example, to focus on the aspect around, okay, when you do climate mitigation, you also have a lot of other good things that happen to a country. First of all, you reduce air pollution. And so you have a benefit in terms of lives saved and reduce mortality, increase productivity in the agricultural sector and things of that sort. So we tried to estimate some of those things. So it was a really interesting 5 years there where I had an opportunity to interface with a very important and really fantastic community around the world doing climate advocacy, climate policy work, etc. I was involved in the UNEP emissions gap reports. I was a lead author for a few years there, introducing all those sections in those reports around mitigation opportunities. Obviously, you had like the science chapters, and then it was about, okay, what do we do about this? Like, how do you actually drive those emissions down? So a lot of that work that I did at ClimateWorks was just, it was a fantastic 5.5 years I spent there really building relationships and publishing work and doing research and funding a lot of advocacy and work on the ground that yielded a lot of success, actually, in terms of the transformational policies around the world that managed to reduce emissions. And then after 5.5 years of doing that work, I moved to New York, also for personal reasons. And I ran into Jeff Sachs, who was the director of the Earth Institute at the time. In the last decade plus, he's become very interested in the intersection of development with sustainability. And so he had this flagship project that he was overseeing at Columbia. It was called Deep Decarbonization Pathways. And it was sort of an evolution of some of the stuff that I had done at ClimateWorks. And so he asked me to come on board and lead this project. And this project was amazing. It was really interesting. This is the end of 2014, early 2015. I had 16 different teams in 16 different countries. These countries represented about 80% of emissions at the time in the world. And so these different teams of scientists and social scientists, so it's a combination. Again, I think that a lot of my career, you have a lot of connecting different disciplines because you need to think about, this is my conviction, that you need to think about sustainability and climate in a very interdisciplinary ways, because there's so many aspects that are touched by these problems. It's important to have people in the room that understand a lot of the complexity, which I think a lot of it is lost, unfortunately, in media and in how people think about it, including in the financial industry. The idea was to say, for each country, how they tackle this idea of reducing emissions so that we stay within a safe climate change zone. Every country needs to do something. And this included, by the way, the US and very developed economies, European countries, etc., but also included economies that had very different emission profiles and very different development stages, like South Africa or Brazil or Russia. Everybody needs to transform their economies in some ways. But not only that, every country also has some other things that they care about, some other priorities that are part of how they want to handle their economies and how they want to build their society or maintain cohesion in their societies. At the time, it was every country team needs to come up with their own plan of what it looks like to do deep decarbonization between now, and this was 2015, and 2050. And what does that mean from the perspective of how your energy system transforms, how you do transportation, how your buildings are powered? First of all, it has to be realistic and it has to be compatible with a bunch of other things. Like, for example, in South Africa, there was a very big consideration around unemployment and in particular youth unemployment. And so how do you do this at the same time as the government also tries to solve this other problem around youth unemployment? Like, what are the levers that we can pull so that this opportunity of decarbonization also becomes an opportunity to increase employment, for example? Or in other countries, it was around, okay, we have less energy related emissions and we have more emissions from deforestation or other things. And so how do we think about that within our context? So the idea was very much every country has to do what's right for them, but that every country team would come up with a plan that was leading to deep decarbonization in 2050. And the definition of that was something around where in 2050, every person in the country would have about 1 ton of CO2 like allocated to them, which is very close to net zero, basically. It was really the sum of all these efforts that would give us a sense of how close of how far all these plans would be from that sort of safe-ish climate change zone that I was mentioning earlier. That was the architecture of the project, which was led by Jeff Sachs, as I said, but it was also involving a couple of other important people. One was Laurence Toubiana, who that year became the person who led the French government's diplomatic effort leading to the Paris Agreement. So obviously, her being very close to this project, you can understand how the architecture of this project was kind of translated into the Paris Agreement. Another person that was important and involved in it, in particular on the French, on the European side, was Teresa Ribera, who's now the deputy president of the European Commission. By the way, she was an environmental minister in Spain for a few years. And so it's really important, again, to have that academic rigor and all these sort of research teams, but also to have that political connection, because you do need this stuff to be translated into policies. And so it's important that these people that do policy, that do politics, they understand the topic, they understand what's at stake, and that they are able to find a way to take this and put it into the laws of the countries that they're operating within. So that was a pretty significant experience. And so lo and behold, when the Paris Agreement was signed, and we were there, of course, and we'd look at drafts every day, etc., this became exactly the architecture of the Paris Agreement, because the Paris Agreement is built on this idea that every country comes up with their own plan. It's these nationally determined contributions. They come up with their own plan around what their emissions profile is going to look like in the next 5 years. And there's supposed to be a bit of a peer pressure so that you ratchet up those commitments every time that you have a review. And the sum of all of those commitments and the sum of all those contributions is where we see how far or how close we are to the overall agreement that all these countries signed on, which is limit warming to well below 2 degrees Celsius above pre-industrial averages. And so that's sort of the story of how the deep decarbonization pathways, but it was also a lot of what I had done before around these scenarios for decarbonization, really became enshrined into something that became the foundational document, the foundational legal document treaty that should guide climate policy around the world.
Then life gets in the way.
Yes. Unfortunately, yes.
Yeah. So you had a front row seat to
Yes.
all of that, and you were there while it was happening. But then in 2017, you left the policy and academic world to join BlackRock, one of the world's largest asset managers. And you joined as a director of fixed income ESG investing. Now, that's a completely different environment than everything you've told us up until now. What was the thought process going on in your head behind that move?
So when the Paris Agreement was signed, as you said, like life gets in the way. I remembered very vividly the failure of Kyoto. I remembered the failure of Copenhagen. And so I knew, but I was a believer in the fact, and I think that this is just the sort of nature of the climate change problem, that it needed some kind of an organized solution that was a globalized solution. You need to do this at an international level because any single country, frankly, I mean, unless you're China, doesn't really matter that much. Even Europe as a bloc, even if it stopped emitting tomorrow, it really wouldn't make that much of a difference in terms of where we're headed from a warming perspective. So it requires some form of coordination, but that's also the difficulty of it. And so how do you solve that? And so I was a believer in an international setup for how we solve this. And naively, I thought when the Paris Agreement was signed, like honest, I just remember sort of this feeling like we did it. I thought that was the end.
Mission accomplished.
It really felt like, okay, that's done. Now countries have committed to it. So now they got to do something and we're going to move on. And I thought, wow, like that's amazing. And so I thought, okay, I've worked for more than a decade on figuring out some kind of a policy and technology mix. So any policymaker within these countries has what they need. This is not rocket science at this point. We know what needs to happen. I wrote so much about it, like the policy mix and how technologies were supposed to evolve and how you use R&D funding for the back end of technology. You deploy everything at scale today, and then you fund R&D so that the stuff that you need in 10, 15 years will be ready when you need it. And then you deploy that stuff. So I had everything very clear in my head. And I'm pretty sure that a lot of people have it very clear in their head. But then I thought there's one thing that we don't really know how to do, which is how to make sure that capital is moving in this direction versus in the old economy direction. How is money going to fund this versus a bunch of coal power plants and a bunch of traditional stuff the way that we've done for the last 50, 100 years, etc. And I had this intuition, which perhaps was the best intuition I've had in my life, which was that the financial industry didn't have the data, the tools, and didn't have, frankly, the expertise that it needed to really understand all of this, measure it, incorporate it in the way that they think about risk, like relative risks in when they make investment decisions. And so I thought that's the next intellectually interesting place to be. It's actually finance. And so let's go see what happens in finance. I had this intuition, and I think it was the correct intuition. And it was also like a moment around 2015, 16, et cetera, where after the Paris Agreement, with a bunch of people from the financial industry being really quite prominently involved in these proceedings, negotiations, and just generally like in the sort of climate space in particular. Mike Bloomberg was one of them, and there are others. Mark Carney is another one. But there was this idea that this stuff would somehow impact capital markets, but they didn't really know how. And so that's how I spent a year doing some of this work on a research side at 2 Degrees Investing Initiative, which was this NGO. I opened up the New York office of the small French NGO that was like a few crazy people, but doing really interesting work. So today, the kind of stuff that we were writing at the time is sort of, okay, like everybody thinks it's part of the basics. But back then, was like nobody understood it or believed it. It was really interesting to see how that happens. And so through that, I met some people and made some connections and established relationships with the financial industry. And that led to me being hired by BlackRock, as you mentioned. So I met this person. Her name is Ashley Schulten. She's the person who hired me into BlackRock. She was a bond trader for 25 years at the time.
She's been on the show, I'd say, within the last year or so. Amazing amount of experience, and was a great show.
She's the person who hired me in. And at the time, it was literally the two of us. We had this little group that was called Climate Solutions, and it was within fixed income. She became interested in these topics because of sort of a nascent asset class at the time, which was the green bond market. And so she had this intuition that this could become quite important and interesting and grow. And we needed to build the capacity within the firm to understand it, to sort of really drive, because clients were already interested. And together we formed a partnership, and it was just incredible. I learned so much from her. I learned so much about the bond markets from Ashley and from working at BlackRock. And then I think that I also brought to her a certain amount of knowledge around other things that she thought was missing at the firm.
Was there a strategy when you were trying to take all this policy and technical background into capital markets? Did you think, yes, fixed income markets, that's where to go as opposed to equity? Or did you run into somebody in fixed income at a bar in New York?
I had met Ashley and just thought that she was incredible. And when she said, I think we should bring you in, it was within the fixed income group. So a little bit of that was serendipitous, but some of that then also was deliberate in the sense that markets are significantly larger than equity markets. There's a lot of really interesting aspects about that markets that I think lend themselves really well to applying some kind of sustainable thinking around them. One of those is the fact that a lot of the equity markets are secondary markets. You very rarely get to buy stocks as a primary market offering. And so how much influencing do you do really in that transaction? Not very much. So debt markets, there's primary offerings all the time. Companies might issue bonds several times in a year, and they have all these ladders and they refinance, etc. So there's a lot of opportunities to actually engage with companies around the time that they want to raise some debt. And so that made a big difference, I think, throughout the work that we did there. It gave us a direct relationship with the boardroom at a lot of these companies. And that was particularly important when these companies were coming to market with a labeled bond offering. So like a green or a social or a sustainable or then sustainability linked bond, because we were the team that was in charge of figuring out whether we would buy that bond or not on the grounds of whether it was a credible bond for us to put in clients' portfolios, something that wouldn't damage BlackRock's reputation if we had in a portfolio, et cetera, et cetera. We launched products. And then there's another aspect, which I think is interesting and maybe a little bit overlooked, which is that when you buy a bond, you have a maturity of that bond. And so you have an exposure to that issuer for a certain amount of time. And that amount of time can be very short, but it can also be very long. And so your risk profile from the perspective of how that company or that whoever the issuer is, it could be a country, for example, what kind of risks that we'll encounter from a climate perspective throughout that time frame of the bond is very different. And so you can really differentiate how you think the risk profile and how you think about those risks because you have a 3-year, a 5-year, a 7-year, 10, 20, 30, 100-year bond. Those are very different risks depending on who issues them. And so there's a lot of really interesting opportunities to be a little bit more sophisticated about how you build bond portfolios around climate and sustainability. So that's sort of how it happened.
The fixed income markets are massive, but they're also notoriously traditional and risk adverse. So here you are. This is 2017, remember. What was your strategy for integrating ESG principles into the bond markets, remember, at institutional scale in that environment? And what was the biggest resistance you encountered trying to integrate ESG principles at a time when this was not at all mainstream?
We always joke that there were benefits and disadvantages from doing things that were a little bit niche at the time. Then it became super mainstream. The disadvantage was that we had to sort of press portfolio managers to be in the room when they had client conversations. And by the way, already back then in 2017, a lot of clients, particularly European clients, but not only, were starting to ask these questions of the portfolio managers. And the portfolio managers didn't really know what to answer. And so part of it was like convincing them that maybe you should have us in the room and we can have that conversation. Persuading these people, it's like, you wake up in 1950, that's the bond market. It's just a very old Mad Men style type of market, right? And so there's a lot of really interesting startups that are trying to disrupt some of that from a technology perspective today. We launched bond ETFs. There's been a lot of really interesting things, but the way that bond markets operate is super old school. And part of it reflects also on the people that work in bond markets, a bit old school. But at the same time, this also gave us a lot of freedom and space to do a bunch of interesting things. And we had the mandate from clients. That's really the important thing. We had clients that wanted us to do this. And we had clients that set up segregated mandates that were only investing in green bonds from very early days, from 2015, 16 or so. So those are pioneering clients, insurance companies. And so there was a very strong group of clients that were super supportive of what we were doing. In fact, they were demanding it. And that's really what helped me and Ashley and then a couple of other people that came onto the team sort of get into the rooms and conversations, and doors open to us. And then we became so central to the way that things were done. And what we did at the time was we built out, like I mentioned, in addition to launching products, green bond, index funds, active funds, ESG or sustainable funds that had different considerations around different fixed income asset classes about how you invest, how you apply sustainability thinking. We built this whole infrastructure around how we invest in green bonds, thinking about, okay, there are better green bonds and worse green bonds, and perhaps there are those that we wouldn't touch. We had the system of shading, and then we had the system that I set up initially very manually. Now, thank God, a little bit more automated thanks to technology, but around how do we track the impact, like these projects that are funded through green bonds, what do they do in the real world? They substitute some gas power plant or coal power plant with a solar or wind power plant. What does that mean in terms of avoided emissions, et cetera? So we were tracking all this because clients really were hungry for this kind of information. They could use it in their sustainability reporting. They just wanted to understand how investing in these kinds of assets could help them make a bit of a difference, but also at the same time not take idiosyncratic risk. It was a very interesting instrument because you just don't take any specific project risk. You take the risk of the issuer, but at the same time, you get some benefits from it that are environmental. And then we set this up across different fixed income asset classes. We're like, okay, when you invest in munis, what do you think about when you think about sustainability? So we build that, and then in securitized, and then in sovereign, across all different fixed income asset classes, how do you think about that? And then putting all these considerations in these sort of sustainable portfolios that were broad asset class portfolios and fixed income that had all of these things, and building frameworks for it. We had a ton of fun and a lot of freedom at the time. So that was amazing.
You guys actually built this market. You must have been working with Marilyn Cici.
Yes, of course. She's another one of my heroes.
She's been on the show too.
I love Marilyn so much. I really consider her one of the just most important figures, really. Certainly in the green bond market, but I think in sustainable finance. And I always invite her every year. I teach a class at Columbia University on sustainable and climate investing. And I focus on public markets. And she's always coming to my class. And she's coming next week, actually, to speak to my students.
Okay, well, say hello. And then you became managing director and global head of sustainable product and portfolio research in around 2021. While you were there, you played a major role in growing BlackRock's sustainable ETF and index mutual funds platform from around 110 billion to more than 500 billion. That's extraordinary growth. That's not just growth, that's transformation of an entire market. So how did you do that?
I was asked to move to the iShares business because the iShares business had already pretty significant amount of assets. 110 billion is nothing to scoff at. When I came over in early 21, they didn't have a dedicated team that was deep into the weeds, I would say, but really sort of good at understanding what about the sustainable product segment was different. The sort of considerations around how do you build product? How do you think about the right indices, building the right indices from the right data sets, like new data sets that are coming? How do you think about performance, and how does that performance angle inform product construction? They didn't really have a dedicated team for that. And so there was a decision at firm level to create that team. And I was asked to come and create and lead that team. It was super interesting because it gave me an opportunity to go from the sleepy fixed income markets to something that was perhaps the fastest moving business at the firm, which was the index business, and Aisha's phenomenal business. And it has to move quickly because it serves a range of clients, which is significantly broader because it goes from, yes, you have the institutional clients, you absolutely have those, but you also have retail clients. So you literally go the entire spectrum. So there's a very competitive market, and it's important to move fast and to have a team of people that understand that. So that's how it happened. And the person who hired me into that business was Carolyn Weinberg. She was the head of product for iShares at the time. And so I came and I hired a bunch of people, and we did all these things that I set out to do. The first is we organized how within the firm we thought about bringing in new data sets that were relevant for describing some sustainability characteristics of companies or assets that we would bundle in portfolios. So that was an important thing, building governance around it, because as you can imagine, BlackRock has everything. It has every possible type of investment approach under the sun. And so every investment team across all these different businesses uses data in different ways. But at the same time, it's often the same vendors, and it's often for the same purpose of thinking about how do you build portfolios and products around that. And so how do we organize that, and how do you do diligence the data for the purpose of the stuff being useful from an investment perspective within our company? And so we set up a process around that, and my team was in charge of a lot of that due diligence, in particular for data sets that were to be used for index products, obviously, which have different needs and characteristics than teams that need data for portfolios that have 30 or 50 securities in them. And my portfolios had thousands of securities in them. So it's a very different need, and just the requirements are different. And so we did that. Lots of learning from that. And that's actually been really relevant for some of the work I'm doing now. And then the second aspect of it was really thinking about how do you frame products in a more rigorous way around what the objectives of what these products are. How do we create frameworks and language and labels around these products? And so that when you go to clients, you can understand based on what they're looking for, what's the right fit. So that was another thing. And also, of course, there's been quite a significant regulatory effort over the last 5 years or since I went to iShares. So also, how do we bring the regulatory angle to make sure that we are complying with it, right? That the labels are what they say they are, that the products are built the way that they say they are. So we were doing a lot of work on that front as well, and thinking about, okay, we have a climate suite, we have a transition suite, and sort of really thinking about all these different product offerings. And then the third, which was really important, which surprisingly was something that had been quite overlooked for some time. That's part of what led to some of the issues around the pushback on ESG in particular, which was, okay, so we're offering these products that are a little bit different than traditional index products. They have some deviation. You have an S&P 500, and then you have a fossil-free S&P 500 product. And that means that fossil-free product is a little different from the S&P 500. How do we think about the financial performance of these derived products, these new products, the sustainable products versus the traditional ones? And what's driving that difference in performance, which we called active return? It can be positive or negative. It's an active return over the traditional index. And so we did a lot of work building research approach around how we think about that, and how do we identify the drivers of performance so that when we build new product or we go back and we change these products, we can improve their financial performance, because we really understand what's actually driving the difference in returns between these products and the traditional products. Because obviously clients look at the return of the S&P 500, and if their sustainable version is doing worse, they want to understand why. And it's legitimate that they understand why. And I think that there's been a bit of a tendency for a few years to sell sustainable investing as a driver of positive active returns. And I think that what we try to do with our work is to say, well, that could be true, but it could also not be true. And we just need to understand when it's true and when it's not true and why, and how to build products that can minimize the times when the active return is negative and ensure that the active return is equal or higher than the traditional index price. So we did a lot of work around that I think has been very important in strengthening the rigor, the intellectual foundation, and the financial case for sustainable products.
What were the main obstacles you had to overcome in mainstreaming sustainable products at the institutional scale? Because I imagine there was skepticism both internally at first as well as from clients.
There's been a bit of a roller coaster on that front as well. I always joke that the 8 years I've been at BlackRock, it's like 80 years in a normal business cycle, because we went from like us being the little people that had to knock on doors in the corner and to be heard, to like catapulted towards the center of everything because there was a very significant and deliberate choice by leadership at the firm to say, this is important and here's what we're going to do. And so that became really important, which was really good for my career. And then the sort of latter part was a significant pushback against sustainable in general and climate and everything and ESG, but also BlackRock in particular as a bit of a spokesperson of that style of investing and that season, if you will. So there were some challenges. And I think what happened was more caution around what we were going publicly with. And obviously that increased the amount of scrutiny around every new product that we would launch and every new methodology, every new index, every new paper that we would write, everything. It's good that my team was there because that's what we did and that's what we ensured. And I had the credibility to do it within the firm and outside the firm. And so that was really helpful. And then I think that for me, there were a bunch of other things that happened, in particular, restructurings of businesses and etc. And so towards the end of last year, 2024, I felt that I was super proud of what we had built, but I also felt like the space for that really exciting innovation, that sort of expansion that we had experienced had narrowed quite dramatically. And so I thought, okay, I think this is amazing. We've had an amazing run, but it's time for me to do something else and to really think about, okay, what's the next exciting thing? I decided that it was time for me to move on.
Let me just back up a second. You're European. I live in most of the time in Europe. And I find that a lot of Europeans look at this ESG period, like you say, BlackRock kind of became the poster child and it sustained a lot of pushback. A lot of people in Europe say, well, in America, this whole sustainability ESG thing was oversold in the typical American way. Do you have an opinion? Because I don't feel like we really have the same thing here in Europe. There's some of that, but I think that happened in a very big way in America. What do you think?
To some extent, some of this pushback is supernatural, and it's a little bit like a Newtonian law. To every action, there's an equal and opposite reaction. And we're sort of experiencing the equal and opposite reaction now. There was quite a significant explosion of ESG and sustainable investing in this phase in the 2017, 18 to 22, 23 sort of period. And like every sort of major expansion phase, I think that some mistakes were made. And so now there's a bit of a backlash and reaction to it. But if I've learned anything from working in markets, and this is really difficult for me because I'm not a patient person at all. You just need to be patient. The return wave will come. We don't know when it will come, but it will come. And my personal conviction is that the return wave is already, in a way, coming. It's already preparing because in the next couple of years or so, it will probably come back with a vengeance. It'll look different. We will not go back to the ESG of 2020 or 2019. We will not do that. This is not going to happen. Because obviously we've learned something from that experience, but something like that will come back for a number of reasons. And I think the first reason and most important reason is that we are observing the consequences of climate change around us. And so we're already living with, and also at the same time, there's been such a phenomenal transformation, in particular in the energy sector around technologies and relative technology costs. Imagine like most of my career here in the US and having to deal with all this denialism, which took different shapes over the years, etc. And it felt really unnatural that for a brief moment in time, everybody seemed to be aligned around, we are doing something and we're solving climate change. I knew that moment couldn't last very long. I thought, it's great. Or maybe some companies are making investment decisions. They're changing some ways that they're doing things. But it was obvious that at some point, all this edifice would sort of come down because of other pressures. And again, it's sort of normal part of Newtonian laws. So I think, so again, counteracting, it'll come back. I think that for a moment around 2019, 20, 21, a lot of people oversold the fact that if you buy an ESG product, you will make more money without having necessarily the data to back that up. That was a mistake that eventually did a lot of damage to all of us that were actually doing rigorous work. That was part of the axis of that period. And I think there's essentially two types of criticism that are voiced against ESG investing. And the first is, if you will, from the right, I would say the political right, which is that ESG is depressing returns because it is selling some products to clients that are subpar products. And so that's one thing. The second criticism is that it is also substituting the financial sector for political decisions around which industries to support and to disincentivize in a way. So there's that criticism. And I think that on the first one, which is about performance, that's, I think, where the mistakes were made. On the second one, which is changing the relative cost of capital, to be honest, I think that there's not a lot of evidence to back it up. There's the criticism from the left, which is, well, basically two things. The first is the greenwashing criticism. You're saying that these products make the world better, but they're not really doing anything. It's just about relative risk and return, which I think is for the most part correct, but it comes back to a bit of a misunderstanding around what ESG is. And I think that in the work that we did at BlackRock, we were very clear about this, but every time I read an article, there was a lot of misrepresentation in the media. So I think the media talked about ESG and sustainable investing as if it were, you're investing in this portfolio and the world will magically be better because it will be really impactful for you not to hold these two stocks in your portfolio. And the truth is that that's simply not possible, but also that is not how those products were sold. The whole idea about ESG was about better risk adjusted returns in a way, but it was really about, can I be a better investor if I consider more, if I have more information about a company, and in particular in the ESG case about their environmental practices or how they treat their employees or how their governance processes work, etc. Does that make me a better investor in the sense of, will it help me spot companies that are risky, but that aren't delivering those returns? So that's more risk for same return means worse return for a portfolio. Or will it help me spot companies that maybe are doing things better and they're less risky, but the market isn't necessarily rewarding? So it's kind of like around spotting those market inefficiencies, if you will, but by having that extra information and making you a better investor. It's about incorporating those material aspects of that material information about an investment in a way that hadn't been done before. And that is good, but it's not about necessarily changing the world. It's about making sure that I take less risks to defend my returns, to protect my returns. In particular, in fixed income, I have no upside. That's where I started thinking about this. How am I a better investor by considering more information? That's the whole thing. I go back to my education as an economist about information asymmetries, information economics. That's the whole basis of it. So for me, that was a very compelling argument, and I still stand by it. Now, the idea that by buying an ESG product, you will solve climate change, that's not what we had said, certainly. And I think that it's been a little bit misrepresented. And there are products that have that objective of having a real impact, but those are very niche products. There's a very small amount of assets that is managed towards that goal, both financial returns and real world impact. This is not the ESG asset class at all. And so there was misrepresentation there. I think that the left sort of attacks have been on that significantly. And then the second attack, which also I stand by, is that you cannot solve climate change. You cannot solve societal problems that are systemic problems that require fundamentally political solutions. You cannot have capital markets solve them. It's just not what they do. It's not what they're for. And I agree with that critique too.
There just had to be a better acronym.
There has to be a better acronym. Yeah. First of all, I hate acronyms. There's so many of these acronyms. This profession has become about knowing acronyms. It's crazy.
Earlier this year, you made another move. You left BlackRock to become chief growth officer at NatureAlpha, which is a much smaller company focused on biodiversity and nature risk analytics. A lot of people would have stayed at BlackRock, but you said that this year, 2025, is a transformative year for nature investing. That's a big bet. What are you seeing that makes you so confident about the timing of this transition from climate to nature as the next frontier in sustainable finance?
One of the reasons that compel me to leave BlackRock and also join a startup company, a young company, a small company, what really excites me is to see the amount of innovation and energy that is still happening around these topics. I really needed that after working at a large company for some time. And so there's just so much that's happening, a lot of entrepreneurial, really interesting ideas and energy being put into building companies. And so NatureAlpha is one of them. And I knew Jan Sharif, she's the founder of NatureAlpha. I thought she was phenomenal. And I thought that the company itself had a really differentiated offering around this idea of how you represent and measure nature-related risks and dependencies. As I mentioned in my previous job at BlackRock, when I was in iShares, one of my responsibilities was to really think about new data sets and emerging data sets and how do we bring them in and do products around them. And nature had definitely become a topic that clients were really interested in the last couple of years or so. But there was a bit of discomfort around the state of the market around data that they could use to understand those risks better within their portfolios. That discomfort was very justified. What I had seen at BlackRock in some of the data sets that we reviewed was that, yes, I mean, they were still a little rough and sort of reminded me of climate data sets like 10 years prior. And so I always think about the emerging field of nature risk, in particular data around nature, and then everything that comes from that as being maybe what the climate data field was in 2015, very early days. But that's also exciting because it's at the cusp of transforming into something that I think could become significant for investors, for capital markets. And so that's an amazing place to be. It's a small company. It's the fact that I think that the NatureAlpha data is differentiated and better than competitors for a bunch of reasons, in particular, because it looks at the geographic locations of the assets that companies own and operate. And that is a very large driver of physical climate risks, but also of nature related risks and dependencies on the ecosystem that you find yourself in. And not only that, but you also find yourself in an ecosystem where other assets are infringing on that. And so you need to think about all those dependencies in a coherent way. And I think that their data sets is really fantastic at doing that in a way that I have not seen anybody else do at the moment. And by the way, the reason why this is possible today and wasn't possible 2 years ago when I was at BlackRock looking at these data sets is because of significant advancements in technologies, in particular AI, in particular large language models that really allow you to have a significant amount of precision, way more than it was before. And also the ability to connect assets to securities and license of companies, which is something that a lot of data sets from the last few years sort of missed. And that is a very important one when you're investing in public markets. And so there's a lot of that's possible today. So that's also part of it, like the AI revolution. So that's one thing. That's what motivated me. I really wanted to work at a startup. I wanted to build something from scratch. I wanted to be in a place where my ideas and my experience had a much more direct result in terms of how the strategy for the company. So that was one thing. But nature itself, it's a very sort of nascent topic. People don't understand it very well. I think there's some advantage to that. And so the big advantage of talking about nature versus talking about climate is that today, at least, and I'm not saying this will continue to be forever, but today it's a bit of a more neutral topic. There's a lot of history around controversies on climate and energy transition and decarbonization and reducing emissions and global warming and all those different words. Think about how the vocabulary had to evolve over the last 20 years because there were always some very significant pushbacks on how the topic was or how the narrative around climate change was presented. And so I think that nature is a bit of a more neutral word that allows us to have these conversations regardless of political orientation of clients. And I think that there's a bit of a more shared understanding that we live in a planet and within a natural environment, we are dependent on it actually way more than it's dependent on us. And how do we think about this in a smart way so that we can be around, companies are being around 50 years and the amount of services that nature's providing, we can still count on that 50 years down the line. So it's a bit more neutral. People have a physical lived experience of nature. I see trees out of my window every day. It's a little bit more tangible than climate. So it avoids a bit of the political aspects and it's a little bit more tangible. We're at the cusp of this major change and the data is improving so much. And so I think that this is a pretty cool moment to be doing work in this space.
So let's deep dive into NatureAlpha. For those that haven't heard of the company, give me the elevator pitch. I know you're not a fund manager. You're building data infrastructure that enables other people to make better investment decisions. But explain that business model to me and what problem or problems are you solving? And then how does your approach differ from what's already out there?
NatureAlpha is a data and analytics company. And what it does is it provides information. It's focused on investors as the users of the data. It's investors and decision makers. And it focuses on, for companies and then for assets, what are the different drivers of risks that are related to that asset being in a specific location or within a specific value chain with respect to nature? And so there's a few sort of layers to how you represent that. And the first is geospatial risk. So it's important to understand where that specific asset is located and how a company, which is simply a portfolio of assets at the end of the day, where those risks are within the company's portfolio of assets and where they're located and what characteristics they have. So you have information about water risks, for example, or you have information about biodiversity risks and things of that sort. So that's the geospatial side. The second aspect of it is to really think about the operations of a company. And so a company has a supply chain. So it buys stuff from others. It has its direct operations, and then it has products. And so how do different aspects about how a company operates, what's the impact of nature on those operations, of natural risks, and what's the impact of the company on the environment, on nature from those operations. And then the third angle, it's a little bit more traditional, and it's something that if you understand ESG, you understand that it's important, which is about how that company is run, which is really important. How aware is management of all these different facets of nature-related risks and dependencies, and what kind of processes have they put in place to mitigate that risk. So it's not only about exposure to risk, it's also about how you're managing that risk. So it's both those considerations. So it's exposure to these risks in particular, like how the company operates, but also where those operations are located. And then it's how those risks are managed, which is the governance angle. And then there's a really interesting way to represent these risks. You can do a couple of things with it. You can do a visual representation through maps. And so you really understand at a snapshot where, for example, you have particularly significant risks in your portfolio of assets or in your portfolio of companies. But the second aspect is also being able to represent that risk in a more synthetic way. And so coming up with indicators that help you understand that so that you can build portfolios or you can represent portfolio risks in a more synthetic way. There's hundreds of indicators and thousands of data points that go into this. But how do you represent it more synthetically? That's another aspect of it. And the use cases for this data, I think it's mostly so far around understanding what you have in your portfolio. So it's really understanding the risks that you're exposed to. And then also reporting, because this data is also built in a way that facilitates reporting around some of the sort of traditional reporting frameworks like TNFD, etc. So those are the use cases. And so what I'm trying to do with this data is to think about, okay, we have all this information that's really interesting around nature risks and dependencies of companies. Can we build indices based on this data that do a number of things? These indices could be broad market indices that allow you to reduce nature-related risks and dependencies while maintaining a very similar return profile to the starting index. So that's one thing. So obviously, that's stuff that we have done in the sustainable space for a long time. Or you could build more thematic exposures that allow you to make a bet on some specific theme. For example, companies that are better than peers at some aspects of it, or companies that provide solutions to solve some of these problems related to nature risks and dependencies. So that's more of a thematic approach, more concentrated. It could also be down the line when we feel that there's more progress in the market. It could also be around how do you build portfolios of nature positive companies, companies that are not only not having or maybe better than peers at not infringing so much on nature or extracting so much without making sure that there's regeneration, but really are positive for nature. The balance sheet is positive in nature's favor from the operations of these companies. And one day I hope that we can get there too. But the idea is really sort of to figure out of this incredible repository of data. Can we select some specific KPIs? Can we select some of these indicators and build indices and then build exposures from these indices and hopefully ETFs and financial products that really take nature in the way that they think about stuff? And to me, that's broader than climate. But climate is included in a way, but it's broader than climate. It's like going one level up in abstraction in a way. You have climate, but you also have water. You also have biodiversity considerations. So you have a lot of these different facets.
I don't want to get too far in the weeds, but you have something called the Geoverse 2.0. And then there's something that's proprietary, a footprint map. And if I've got this right, just to give people a flavor of it, these tools analyze 8.5 million asset locations worldwide with something like 99.5% accuracy. So this all sounds incredibly complex. What does this actually mean, though, in terms of providing actionable investment insights for a portfolio manager?
That's some of the work that I'm leading right now for NatureAlpha. And it's only possible because this data repository is already there. So now some of the work I'm doing is I'm having fun with it. I'm saying, okay, I have this information. Now, if I were to use this information on a portfolio that I know, say, for example, take the MSCI world, what does that tell me about that portfolio? And if I were to use some of these indicators to create a slightly different portfolio, what characteristics would that portfolio have? And so that's some of the work that we've done. And we've published a paper just recently. It came out last week. And the paper sort of goes through some of the process, but I'll describe it really quickly. This is very similar to what we used to do when we sort of played around with other data to understand how to build products at BlackRock. So obviously the experience comes from there. And so the idea is to say, okay, take, for example, two indicators, because you want to do it on a two-dimensional scale, because otherwise it becomes too difficult for us to think about. Think about ecosystem integrity as one variable, and then think about dependency on that ecosystem as the other variable. It's about how the ecosystem is doing and how healthy it is, but it's also how dependent you are on that ecosystem for your operations and for making money and for operating as a business, because that's really important. You represent this on a quadrant. What you're really interested in terms of the risk for your portfolio is the quadrant where you have both high dependency on that ecosystem, but also that ecosystem is at high risk of deteriorating. You have an ecosystem which is at risk. It's starting to not operate at a level that it used to be operating at, but at the same time, you're highly dependent on it. So that's really the quadrant that I'm interested in that portfolio. So first thing I do is I plot the securities in that portfolio and I identify the securities that fall in that quadrant. And one of the first things I want to understand is from a statistical perspective, is it just like 10% of companies across every sector that fall in that quadrant? Or is it specific sectors where 80% of the companies fall in that quadrant? Because that's a very important question, because when it comes to portfolio construction, it's very difficult to build a portfolio. And we sort of go back to that idea of how you build financial products with sustainable considerations. And a lot of the traditional approach was to screen out certain sectors. So you take out that risk. And there are some valid reasons why you may want to do that, for sure. For example, if you're a values-driven investor, you might simply not want at all to have anything to do with certain things, say, I don't know, tobacco, for example. But there are also risks from doing that, because this is very intuitive. But if you're taking out an entire sector and say it's automobiles, and for the next year, there's a rally in the automobile sector, you're really losing out on that performance. And so you want to be a little bit more deliberate about how you structure the portfolio. And you don't really want to take that big deviation from a traditional index by taking out an entire sector, unless it's for values driven reasons. So the first thing I do is I look at the characteristics of companies in that quadrant that has high dependency on an ecosystem, but also where the ecosystem integrity is most at risk and most deteriorating. And what do I observe? So I did this exercise in the MSCI World, for example, index, which is basically developed world equities investable index. And what I noticed is that there's definitely a few sectors that are way overrepresented there. And some of them are energy and utilities. And there's more, like real estate is another one, for example. That tells me something important, which is that if I'm building a portfolio using this information, I have to be really deliberate about how I use this information so I don't create a crazy deviation from a sector allocation perspective in that portfolio. And the good news is that you can actually do that with optimization techniques. And so that's why we have data scientists in-house that are helping me do that. We set up an objective function and we say we want to reduce the exposure to companies in that quadrant, but we also want to do it in a way that doesn't explode the tracking error and that gets me to a final portfolio that is quite similar in terms of risk and returns characteristics, sector allocation characteristics, all the financial characteristics that you can think about, as similar as possible to that MSCI World starting portfolios. And so that's what we've been playing with. And we've made some interesting observations about the return characteristics of companies with high and low risk in that portfolio. And in particular, what we found is actually that the market is to some extent reacting to these risks, but it doesn't yet have all the information to do that. But there certainly seems to be a bit of a premium that the market demands of companies that have high risks related to natures. And so that makes intuitive sense, but we're trying to pinpoint where that comes from. But we're trying to use this information to think about how we build portfolios and how do we build portfolios that, again, will get you a very close return to the starting index, but reduce nature-related risks. And at the same time, don't get a lot of deviation from them. And that's sort of how we're playing with the data at this stage. It's very early days, but that's sort of the type of research that we're doing.
This footprint metric that I mentioned, it uses scientific concepts like potentially disappeared fraction of species. So this sounds like quite complex ecological concepts. I guess the question is, how do you translate that level of complexity into something a portfolio manager can act on? And there's always this tension between scientific accuracy and business usability. So how do you balance these competing demands?
That speaks to the importance of having people that understand both the ecological science and finance and portfolio construction, which I think is one of the value drivers for our team, because Vian Sharif, who's the founder of NatureAlpha, she has a PhD in conservation, I believe. So she's really been thinking about this kind of stuff from a scientific perspective. But then she also has worked in the financial sector. And obviously I come in with that experience. And so we're combining these two things. And I think, by the way, this explains part of the success of ESG data vendors is that they tried to summarize a lot of characteristics about a company into one number, into this ESG score. One of my crusades when I was at BlackRock was to say that score itself doesn't really tell you that much about a company. And you actually need to dig deeper and really understand what are the drivers of that score. First of all, you need to decompose it. Environmental things are different from governance things, etc. This is all the conversation around how they put together these three things that maybe they didn't go well together. But the bottom line is every company is multifaceted, and certainly ecosystem integrities is multifaceted, and nature-related risks are multifaceted. All the stuff around the ecological interaction of companies with their environment is complicated. And so on the one hand, it's good to simplify, but on the other hand, I really don't want to get to a point where we just do a portfolio running on optimization on one variable. I really don't want to do that. So the question is, where do you find the balance? So again, we have some experience with how we've done this with climate. And what I advocated for when we were building this framework around how we do climate products and climate investing was this idea that you actually need to have a dashboard approach to how you measure not just the performance of companies or along this idea of how well they're transitioning or how much risk they're taking on, etc., but also around the types of products that you're offering depending on what your client, who's the asset owner, ultimately wants to accomplish. And there's going to have to be multiple ways to do this. There's not going to be one way. For example, when we were thinking about climate, this is an example of some of that research that I mentioned that we were doing at 2 Degrees Investing. And then sort of only 10 years later, it became common knowledge people believed, but at the time people didn't believe. And so what we said in 2015 was there's very little correlation between how much a company is emitting in terms of greenhouse gases and their climate related risk for a bunch of reasons. They might be emitting a lot, but not be subject to a lot of risks because the policy isn't going to change or the technology isn't changing. And vice versa, you may be a very low emitter, but you might be subject to some other disruptions that might put you out of business. So those two things are actually not very related. And one of the ways to think about it, to think about how well companies are transitioning and also about how portfolios should consider sort of the trajectory of companies and not just where they are today. Of course, emissions data are also backward looking and we have all those problems, etc. But it's also about, okay, if you think about the economy that we're trying to move towards, an economy that's decarbonized. It's essentially an energy system that's decarbonized or that shifts away from fossil fuels into something else. It's electrified, it's efficient, etc. And so who do you need in 2050 to ensure that system works? I mean, we're moving from fossil fuels that power all kinds of stuff to electrifying everything. And you need somebody who provides that power. But at the same time, power utilities are highly emitting today because they still have significant amount of fossil fuels. But they also have the technology and the ability to invest in a technology that is decarbonized, and they're doing it. And so if you think about the portfolio that you want in 2050, you actually want a portfolio of power generators that are cleaning up their act. That's what you want. You don't want to exclude them just because they have high emissions, especially if you're interested in financing that transition, especially if you're interested in providing the capital for what needs to happen to an economy. And so you do need that dashboard approach. If you only focused on one or two metrics, and we did these experiments, and I don't remember if we published it, probably not, because it was already times when it was really hard to publish these things, but you do these experiments and you look at, okay, if we were to apply some traditional metrics to how you do climate exposures, you would have a portfolio that's healthcare and financials. That's what you have because you're using only scope 1 and 2 emissions. Is a healthcare and financials portfolio a portfolio that helps the economy decarbonize? I don't think so. I mean, financials, you could argue, but it's not really because of that reason that it ends up in that portfolio. It's a complex conversation. And that's why you need a dashboard approach. You need to really think about the multidimensional problem. And you need to think about what's the objective of that portfolio that you want to build. And there's going to be multiple products, multiple portfolios that do different things, and they're all valid. It just depends on what you are trying to do with your money, what you're trying to accomplish, and your risk appetite, etc. So it's complicated, but we're trying to work on that.
You've formed some significant partnerships with MSCI and ICE and LGT, private banking. What makes these partnerships successful, and how do these partnerships help scale the adoption of nature analytics?
So the partnerships with established players are really important when you're a small startup. And so I think in particular, for example, the partnership with ICE, which I'm more familiar with because we're working with them on a number of fronts, it's helpful because a lot of the clients that we're going after already have a relationship with ICE and they're interested in having a conversation about nature risks. And so it's helpful when we can be in that room, even if we maybe didn't have that relationship before with the client, because ICE brings us into the room. And so we have very fruitful conversations with these clients and they end up perhaps buying our data and subscribing to our data. And so it really helps us scale the commercial side and grow the client base for our product. And another thing that's interesting from our perspective in partnering, obviously the private banks is another really interesting example because they also have relationship with clients. And so the idea is really, how do you get to the client? How do you get to the client that would be benefiting from using this data, that is interested in understanding these things and for whom the data can be important and interesting? So these are the partnerships that we've created. But we're also in discussions with many others. And I must say that the commercial response to the NatureAlpha data offering has been just so phenomenal. I almost didn't expect it to be so phenomenal. And this is true on both sides of the Atlantic and in Asia and across regions, which I think gets back to my point earlier, Scott, that the nature entry point is neutral enough and not politically tainted that it's gaining a lot of traction. So I'm really quite impressed. And obviously a lot of it is our team and really brilliant people, but it's really fantastic to see the interest in this.
NatureAlpha aligns its solutions with various emerging regulatory frameworks like, here we go, TNFD, which is the Task Force on Nature-Related Financial Disclosures, the CSRD, which is the European Corporate Sustainability Reporting Directive, and the SFDR, which is the Sustainable Finance Disclosure Regulation. So for those who are not familiar with this alphabet soup, explain what these frameworks are and why compliance is becoming a powerful driver of the demand for your services.
TNFD, the first one in this alphabet soup, the Task Force on Nature-Related Financial Disclosures. This is a voluntary disclosure framework. It was shaped in a way that resembles very much its sister, which is the Task Force on Climate-Related Financial Disclosures, which was launched in 2015 by Bloomberg and Carney, like I mentioned earlier. It was a sort of a first attempt to think about, okay, what are the metrics that are important from a perspective of disclosing what companies, some characteristics of companies with respect to climate or with respect to nature. And so there was a lot of work that went into this. And actually I had the BlackRock colleagues that participated in TNFD as well, collecting expertise and crowdsourcing this expertise and figuring out what are the metrics that are relevant, what does a relevant disclosure look like, what is something that is usable for investors, and what is something that is also practically doable by companies. It's always difficult in the beginning when you're approaching these disclosures. You might not have a way to collect this data. You haven't done it in the past. So you have to sort of really set up a whole infrastructure to do that. But that's what TNFD is. So it's a voluntary disclosure framework. As it happened with TCFD, these voluntary disclosure frameworks typically become a bit of a standard in the market. Companies, especially large companies, use that as a template to do many other disclosures, and it's sort of become a bit of a global template. Even if it's voluntary, it becomes a bit of a global template. And that's great because as an investor, it allows you to compare different companies side by side, which is fantastic. So that's TNFD. CSRD is a compliance framework. This is a European effort to have companies disclose on in many indicators, in fact, hundreds, around their sustainability characteristics. And this covers climate, but it also covers nature and a bunch of other things. This created a little bit of controversy because just the way that the European Union regulated disclosures under CSRD, there were a lot of companies in other jurisdictions, including American jurisdictions, including financial companies, that had to report under CSRD. And so there was a bit of a pushback on this, I would say. And a little bit of pushback also, although initially the requirement is for large companies, really, and it's by revenue. There was a bit of a pushback from smaller companies that were like, we just don't know how to do this. Who can help us do this? Because of that, the implementation of CSRD has been delayed, but that's definitely something that companies very soon will have to deal with. And so that's important. And there is a component here, as I mentioned, around nature and biodiversity. That's very important for this space. And then the last one is SFDR. It's the oldest, certainly, of these three that we are mentioning today. And that's a disclosure regulation that affects financial companies in particular. It's not all corporates. It's really financial companies, and it's about the products that they offer, and it's about their own operations, but it's really more about products. It's meant to represent the sustainability characteristics of the portfolios that they're offering and that clients are buying ultimately. And so that is something that I think is pretty established today. All financial institutions have to report in Europe, and outside of Europe, we had to do it at BlackRock because, again, the actual reach of the regulation is broader than just simply the European jurisdiction. And so it's important to have, when you're buying data sets from vendors, it's really helpful as an end user if that data set allows you in a pretty painless way to build a report, like an output from that data concerning your assets or your products, etc., that follows a specific regulatory requirement or even a voluntary requirement, because you have a template and you can report against that template. So that is a bit of a practical advice for anybody who's looking at buying data. Always make sure that is part of the offering, because that will make your life much easier than if you don't have that. So obviously NatureAlpha has that.
You've spoken about NatureAlpha's double dividend proposition, which is achieving lower nature risk combined with competitive market rate financial returns. Can you explain how that works in practice?
That's part of the research that we're doing now. It's what I was mentioning around how we are thinking about, out of this giant repository of data points that we have, how do we extract the ones that are more financially material and use it to build portfolio exposures? This is important from an index perspective, where typically somebody who buys an index product has a low risk tolerance, right? They want a product that's simple, where you can track performance really easily. We want to be able to build products that have that characteristic that is very similar in terms of risks and returns to the starting exposure, the starting index, but also that in a way that delivers you some, I will call it alpha, because alpha comes in two ways. It comes in the form of lower risk for same return. So if we are able to demonstrate that we're reducing nature risks in that portfolio, but deliver you the same returns, you're better off. You're taking less risk and you have the same return. You want that portfolio. Another thing, which it could be same risk for higher return. So you could do something that has a similar risk profile to the starting portfolio, but is tweaked so that you can actually get better returns. For example, you overweight some companies, underweight some other companies. But alpha takes both of those forms. And the idea is to try and prove how this information that we have around the nature-related risks and dependencies of companies can help us build exposures that do this, that deliver financial performance close to the index, but either with less risk or with higher return.
I think you must have a really unique perspective, having scaled climate finance at BlackRock and now working on nature finance at NatureAlpha. What do you think are the key lessons from your climate finance journey that apply now to biodiversity investing?
First is be very honest and upfront about what you can do, but also the limitations of what the data helps you do. And that sort of to avoid all that pushback that we had with ESG, where some people oversold what those products were going to do. So for me, I really value transparency here. And also because I think of my academic background, my approach is I do it out for everybody to see so that they can tear it apart and tell me where I'm wrong, so that when I eventually build an index, I have stress tested this thing and we're not making claims that aren't real. There's always stuff we couldn't have known, but the stuff that we could have known, we stress tested. So for me, it's about this transparency and approach, and be very honest about what you're trying to do and what you're trying to build, and eventually how you're going to sell this product. And the second, I think, comes back to a bit of what you were saying around the trade-off between simplification and complexity and simplification. It's really difficult to find that trade-off. But again, I think that if we are transparent about this, I think we can get to some place where we are comfortable. And over time, thanks to technology, probably that will allow us to have more complexity, but at the same time, products that are still very viable and liquid, et cetera, and stuff that people are happy to buy. But we need to be honest about that too. We need to be very honest about it. I've looked at a number of offerings in the market around indices that have something related to nature, biodiversity in the name, and they typically include one variable that's related to nature, biodiversity. And for me, that is too little. that is one variable that it might not even be relevant for all the companies in the portfolio. That's not enough, but it cannot be 100,000. And so we need to figure out what that right balance is, as you were pointing out earlier. So for me, that's another important aspect that can only happen if you're open and transparent with the market around what you're trying to do and how you're doing it and your methodologies and some of the research you're doing, which I think we're trying to do.
You spent years believing that introducing carbon pricing would magically make everything happen. What makes you skeptical today that market-based solutions are, in fact, the answer?
I came to this problem with a bit of a traditional orthodox economic conviction, which was if only we had the right price for everything, then things would magically fall into place. And I think that part of my disillusionment with that is that, number one, it is very difficult to actually have a carbon price implemented at a level that you need across all jurisdictions that will really produce those results. There's a political difficulty of doing that. I mean, look at the debate in the United States. There were carbon pricing bills like since the early 2000s. Nothing will ever come out of that, like ever. The Waxman-Markey, the failure of Kyoto, like all that kind of stuff is history we know really well. So there's a political difficulty in doing that. The last 20 years of politics around climate, I think that there's been a bit of a missed opportunity around the narrative on this too. I think we either only talked about sacrifices and sort of dramatic changes to the ways that we need to do things, but we never really showed people the costs of not doing anything. That is a very significant problem. But I think the second aspect of my disillusionment comes from the fact that even in jurisdictions that have implemented quite broad carbon pricing approaches, and by the way, the EU is one of them, some progress has been made, but not even nearly at the level that was needed. And part of it is because prices were too low, and there's a bunch of different reasons. Again, like the politics comes in the way. And so I've sort of grown disillusioned with it. And I remember that so initially I thought, okay, carbon prices are a necessary and sufficient condition for this to happen. Then around 10 years ago, I started thinking maybe they're necessary, but not sufficient. And now I'm not even sure they're the necessary point. Maybe there's other routes that we should think about, but I am convinced that the solution has to be political as well. There needs to be political coalitions that come into place that really demand this. And there seems to be a bit of a disconnect between some of the information or the data I read about how people think about these topics. It seems like a majority of people, including in the United States, think this is important. They see the effects of climate change, etc. But at the same time, they either don't really translate that into action when they vote, for example, when they make voting decisions, or there's a generalized feeling of helplessness and hopelessness, like we cannot really change the system. And so we cannot change the system in a way that allows for humans to save ourselves. And so I've been thinking a lot lately about what that change would mean and how maybe our economy needs to be reimagined for that to happen. And these are just sort of very intellectual, completely philosophical thoughts right now, but it's something that I'm spending more time thinking about because of this experience, I think, with observing what happened in the climate space in the last 20 years.
Laura, I'd like to shift gears now and talk about your new podcast, which is called Moral Revolution, which you co-host with Tony Annett. In your podcast, and I think there's only 4 published episodes so far. I had a look. It's quite fresh.
Yes.
And you explore the intersection of ethics, economics, and environmental stewardship. This seems quite different from your technical work in data analytics. So what drove you to start that project?
It was a long time in the making. Tony is a friend, but we met when we were both working in 2015 with Jeff Sachs. And Tony was in secondment from the International Monetary Fund. He has a PhD in economics. He studied at Columbia. Then he worked for a long time at the IMF. And he came to work for Jeff that year, which is where we met. 2015 was a year where we talked about the Paris Agreement. We talked about the work that I did in climate, but it was a year that was also really fundamental, I would say for me, because of the issuance of Pope Francis' encyclical, which is called Laudato Si, which I think really connected for me. I always had this intuition that environmental issues were deeply connected with social justice issues. That's why I worked on climate change for my entire career. I found it intellectually interesting, of course, and all these different facets, but I also felt I was trying to do something to make the world better, just do my part to try and move things in the right direction. And so when the Pope wrote this encyclical, it was, for me, it was such an eloquent way to sort of combine, to really put words into something that I had felt for a long time or had thought for a long time. And it's such an eloquent way of providing moral leadership around why we need to do something to address climate change. And so that's the year I met Tony, and Tony was working on these topics and I was working on climate. So it's very connected. And we talked about my journey since then and certainly connected to these topics. When I left academia and I went into the finance sector, obviously you're a lot more limited around what you can say publicly, even if it's your own opinion. And so that became really difficult. But we've been friends for a long time with Tony, and we also have another third musketeer in this friendship. But the two of us in particular, we always have these conversations that were amazing conversations, and he brings that very deep Catholic social teaching perspective, and I bring the financial angle, both economists, and we're both thinking about there's a lot that is going wrong with the way that our economy is working, et cetera, and it's just not sustainable, not from an environmental perspective. It's just not sustainable in the sense that it's not possible to go on like this for a long time. And then we thought, when I left BlackRock, I've been wanting to do this for a long time. I always loved radio before podcasts were a thing. I had always this thing. Among the many things I wanted to study when I went to university was journalism, but I didn't do it. It was like, let's just do it. All we need to do is buy a microphone and we learn. It's been so interesting because I think it really helped crystallize some of that thinking. Hopefully it resonates with the people who listen, but we are writing about this. We're putting a lot of these thoughts in writing and we're talking about it in our podcast. We talk about some specific periods in history that we think are important and interesting to understand where we are today and so to draw lessons from. Or we talk about specific topics that are at the intersection of economics and ethics and some philosophy. And so, yeah, it's a labor of love and I'm really loving doing that. And by the way, for those who want to take a listen, I've interviewed a couple of people in this podcast that I think are incredible because, as I mentioned earlier, I decided recently that if there's somebody that I come across whose ideas really, I find just, I don't know, like inspiring, but really kind of mind blowing, I just write them an email and I'm like, hey, I came across this thing and it's just incredible. And I wanted to let you know, incredible. So grateful for your work. Do you want to come on my podcast and talk about it? And somehow these people have said yes, which is shocking. So I interviewed very different people. Silvia Federici is a feminist Marxist philosopher, and she's just somebody who has been so influential in the way that we think about labor, in particular women's labor, is valued or undervalued in our economy today, which again, this idea that there's something that's not quite right. And she thought about the connection of that with the way that we don't value nature. We use it, we treat it as a resource to extract and we don't really value it. And so that was an interesting conversation and there's more. And it's been so fun.
I think you talked on the first podcast about reclaiming moral language in public life. In your view, what's missing from how we talk about economics and finance that you're trying to address with this podcast?
I think that we have completely abandoned moral language in economics. If you think about the way that economics is taught as a discipline in every economics department on this planet, by the way, because I always joke that there's been an inquisition in the Catholic Church where ideas that were a little bit different were punished severely. That's what happens in economics departments today. And I'm studying theology, so I know that. There's a lot of space in theology to critique and to come up with new ideas. And there's space for that discussion. And there isn't that space in economics departments. But I think it's crazy. And it's ultimately going to lead to the demise of this profession, which we're already seeing today with this pushback against expertise. And by the way, a lot of the traditional economic models can't even explain what we're in today. So in traditional textbooks, you're taught that the economist should not even think about any moral considerations. It's all about efficiency. And you don't really care how you get to that efficiency because distributional issues are for governments to solve, for example, except that the role of governments has been also diminished over time. And economics does not take that into consideration at all. Like, what's the role? What power do people have? What power do people have to compel governments to take on the distributional job that is supposed to be their job? And when I talk about how I started understanding that there was something wrong with economics, or that didn't fully sort of satisfy me intellectually, this sort of discomfort with that efficiency only angle and no moral considerations. And so you can have an economy which is super efficient, but where 99.9% of people are starving and one person's fine, but it's efficient. It's just not distributionally efficient, but they don't care because that's not how capital is allocated, resources are allocated. That didn't sit well with me. I didn't really pursue a critique of that so strongly right away. But now I'm coming back to that and I'm like, over these 20 years, there's so much about it that is fundamentally flawed. And there's a lot of really interesting thinkers that are talking very eloquently about this. One is Clara Mattei at Tulsa in Oklahoma. And there's many others. I mean, Federici has one of these critiques, Jason Hickel, all the growth or post-growth thinkers. There's just so much interesting thinking right now. The well-being economics angle, the donut economic. There's so much interesting thinking in economics today that starts to question this more profoundly. And the funny thing is that Adam Smith was a moral philosopher. Economics is a social science. It's supposed to describe people's behavior, describe how we interact as a society together, how we decide to have interactions with each other. And human beings are moral beings. This is just established. And at the same time, this discipline pretends to describe human behavior while humans are not moral beings at all. So this just doesn't work. It doesn't work as a science. And there's a really significant need to bring back some of that moral language into how we talk about politics, which is how we organize ourselves as a society. This is also what Aristotle said, that human beings flourish only in a political environment, which is the city, the polis, and that virtue should be the way that we organize ourselves. It's both a life objective on a personal level, but also the communal objective. And there's such a rich tradition of thinkers and philosophers and writers that have thought about that. And economics has completely rejected that. And our political discourse has completely rejected that. And I think that there's a desperate need to go back and re-inject this moral language and have ethical leadership. And I find that there's very few politicians that do that. And when you have a conversation around what's happening today is warring in many parts of the world for different reasons, conflicts and authoritarianism, etc. And the most opposition parties' talking points are around, oh, this is not normal. This is un-American. And I'm like, this is such weak language. You need to say, this is wrong. This should not be this way because it's wrong. It's morally wrong. And very few politicians have the courage to use that language. So Tony and I have talked about this for a long time and advocating for a moral economy and advocating for that language to be reclaimed back into how we talk about how we organize ourselves as a society.
Was there a particular moment that crystallized this for you in your mind?
I think about my Catholic upbringing and the social justice upbringing. And then I think about Laudato Si. And then I think about all this journey. And I think for some of these years, I thought I had a very clear sense that what I was doing in my work was also like satisfying me from an ethical perspective. For most of my career, I've had that. So I was really lucky. Super privileged to be able to do that. But I think that more recently, I've started to examine it more deeply and think about, okay, I think it's just because I was at BlackRock for 8 years and I couldn't really write about this. And now I have this kind of like FOMO thing and I need to talk about it. I need to write about it. And I just want to put my thoughts and thinking out there and engage in the sort of intellectual marketplace. And maybe nobody cares. And maybe these ideas aren't that popular, which is fine. But I think it's important for me to put it out there. So that's where I'm at right now.
You're currently pursuing a master's degree in theology and ecology at Princeton Theological Seminary. Why?
So I interrogated myself on a few things over the years. And one of it was, why are we in this predicament today? In particular, I'm thinking about the environmental crisis. Why are we in this predicament today and what went wrong? And what, if any, role has organized religion played in us getting here? And so there's a really interesting, eco-theology as a field is a very recent field. There's been some really interesting writing starting in the late 60s, in particular 1967, Lynn White, this paper around the role of Christianity in causing the current environmental issues. And so that sort of gave rise to this field, which has been really interesting and rich, but it's still very recent. So people are contributing to it, novel ideas, but it's very recent and nascent. And so part of it is to understand that to the extent that our culture, of which religion is an important part, religion tradition is an important part, certain for a large part of the past few centuries, to the extent that it has some responsibility to how we think about nature, theological words about creation, about natural resources, the world that we live in, the physical world that we live in, for a bunch of reasons. It's been devalued over the years. Part of it is the material versus the spiritual. Religion has privileged the spiritual. There's many other reasons, but there's interesting sort of things to think about. But what role has it played? So that's one thing. And then the second is, which is actually more important for me, is the predicament that we're in now. How can we leverage theology, moral philosophy, like sort of the ethical angle? And does religion have anything to say about this? And can that be a lever that we can pulse? Because it's something that unites a lot of people. More than 60 or 70% of Americans are identifying as religious. And the vast majority of them are Christian. Obviously, there's different Christian denominations. But to me, that's an opportunity to say we have something in common. And that's something pretty deep. It comes back to how we view ourselves as an identity, our culture, our beliefs, etc. So if that's true, that we have this in common, can we leverage what we have in common in some way to solve some of these problems that we have today? And so I'm trying to figure out, what does theology have to say about this? How can that become a lever that we can pull? Then, of course, there's the interconnection between the ecological crisis and the economy, which is very strong for me. And I think that's what I bring into these studies as well. But it's a really interesting intellectual exploration, and I'm learning a ton. And there's some really just beautiful ideas that I'm exploring, very compelling. We'll see where that leads me.
Oh, that's amazing. That's an amazing addition and integration of a completely additional dimension that, as you say, used to be there, but is kind of vacuous at this point. For someone listening to us right now who manages capital, whether that's a pension fund, family office, asset manager, what should they be doing differently starting now based on what you've learned about nature risk?
So I think for me, the very first thing is information is power. If you don't have any kind of information at your disposal, any kind of data around whether the investments that you're holding in your portfolios can continue to operate, for example, in a diminished ecosystem, or especially when the companies or the assets that you hold are very dependent on that ecosystem. It's a little bit like flying blind. And so the first thing I would say is, because information is power, you want to try and get that information. You want to understand what's out there that's available to you, and just start looking at what you have so that you understand some of these things. Because it might be that you're holding some risk in your portfolio that you're not aware of and that you're not being fairly compensated for. So that's the starting point of everything. I think the second point comes back to my thinking around what's the role that you would like to play in trying to have a positive impact on the way that we interface with nature. What are the easy things that you could start doing? And what are the difficult things that you could start doing? You as an investment manager, maybe as an operation or as a bank, but also as an investor, how can we participate in the regeneration of nature, which is something that we depend on so strongly, but we don't really value and we don't put in balance sheets. And that's a significant risk. So I think these are the two most compelling pieces of advice that I would give.
What's the biggest lie that the financial industry tells itself about sustainable investing?
I think there's one lie that the financial industry just perpetuates. It's not about sustainable investing. And I think the big lie is that investing is complicated. They convince you to pay a lot of money to some manager to invest your savings. And the truth is that it's not complicated. Or I should say, there's so many ways today to invest that are so cheap, and really they don't have to be complicated at all, that you don't need to overpay some guy that takes 2% of your assets each year to get you the returns of the S&P 500. So in that way, we can have conversations for 3 hours probably about whether index investing is a positive or a negative for markets, efficiencies and whatnot, but it's a definite positive for investors, in particular for small investors like us, like normal people. It's a very old book from about 100 years ago, and it was called Where Are the Customers' Yachts? And it sort of gets to that issue, which is, if it's so true that these people are so good at managing my money, where are my yachts? I don't want to see your yachts. I want to see my yachts. And so where does this compensation go? And how can I avoid paying so many fees to somebody who's pretending to do a lot of work, but ultimately is really managing against an index at the end of the day? So yeah, people can avoid that today, and they can do it for cheap. It's certainly for cheaper in the US than elsewhere. And there are other problems sometimes around distribution in Europe that increase costs. But man, has that been an amazing innovation that has, and I think the financial industry doesn't really want you to know that. And they try to sell you expensive products. So don't buy those products, buy index products.
Before we finish, I want to ask you something more personal. You've built this long and actually remarkable career bridging science and policy and finance. But what drives you personally? When you think about the impact you want to have on the world, what gets you up in the morning?
For some reason, and I don't know if it's because I'm also studying theology, but I think I've been like this a long time. I think a lot about what I will leave behind. And I don't care about leaving behind money or assets or things like that. I care about leaving behind something that people will remember as a positive thing. And maybe it'll just be a few people, but basically to be remembered as a positive force for change in the world. And I think that my main motivation, especially since having children, has been to really think about how do I make them proud? How do I make them proud of me being their mom? It's a lot of small things, but it's also like this sort of ultimate project. Like, what's my life project? Don't get me wrong. I don't have any sort of hero complex. I understand that no person by themselves can really change the world. And it always takes convincing people to come along on the journey. And that's really important. And it's about building those coalitions, and it's about having the right narratives in place, etc. And it's about convincing people. But I would like my children to be proud of me, and I would like to leave something behind that's thought of as positive, even if it's small. That's what I've been trying to do, and that's what I will continue trying to do. And hopefully I will manage. We'll see.
I'm sure you will. Laura, I got a few rapid fire questions for you before we wrap up here. And don't overthink these. Just give me whatever comes to your mind. Or if nothing does, feel free to take a pass. That's okay too. If you had to name the single most important challenge in the nature, capital, and biodiversity investing space at this time, what would it be?
I think the biggest challenge today is to overcome the perception that we don't have a way to understand it, and we have data, etc. So yeah.
What do you know now about sustainable investing that you wish you would have known in 2017 when you showed up for your first day at BlackRock?
I wish I would have known that it was such a wild roller coaster, because I would have prepared myself. Every experience is a learning experience, and there's no waste. The experience with sustainable investing in the last decade has taught me so much that I hope can really make the work that we're doing now in nature, for example, first, advance more quickly, and second, just avoid the pitfalls that we've run into in the past 10 years. So all good, but it's been a wild roller coaster.
You don't have to name names, but can you describe an example of an investment that you were convinced of at the time that it ticked all your sustainability boxes, but in the end, it didn't turn out? And what was the lesson learned from that experience?
Have you seen the performance of renewable energy stocks in the market in the last few years? I mean, I think I would say, like, thank God I wasn't an investor in the early 2010s and early teens, because I would have lost a lot of money. I remain convinced that there is an investment thesis behind that, but it's been a very wild ride. So that has surprised me to some extent. But again, with the benefit of hindsight, we've learned a lot of things, and we've learned that in a market that is so prone to disruption because of the costs coming down so fast, it's a good thing for climate, but it's a bad thing for the investor. And so I think it prompted us to think about, okay, what's the right trade-off there? And how do we think about that?
So what's the lesson learned from that? And was that foreseeable, actually?
To some extent, it was foreseeable, because it is a fiercely competitive market where costs are coming down very quickly. And so if you're a developer of renewable energy projects, for example, and you have to bid, there's been a crazy downward pressure on the bidding for these projects. And then what happened was that the macro environment changed completely, and the increase in interest rates made these projects very difficult, because financing capital was very difficult. And so a lot of them couldn't even build what they had bid. And so to some extent, yes, it was foreseeable, because it is a little bit textbook economics, super competitive market, costs coming down. It's really hard to make a profit. Come on, we knew this. I think the macro environment was a little bit harder to predict, because it was brought upon by the pandemic after a very significant amount of time of low interest rates. And so that was difficult to predict. But the combination of the two has been really difficult. So yeah, lesson learned.
Now, the converse of that, can you describe an investment that you were skeptical of, either at the time you invested or maybe you ultimately passed on it, and in the end, it actually turned out way better than you could have ever imagined? And what was the lesson learned from that experience?
I think for me, it was the whole AI craze, especially in the early days. So the reason why I was a little skeptical about this whole explosion of AI, let's say, in particular financial markets really rewarding AI companies, was that, and I think because I come from the power sector sort of school, is I was a little skeptical that the infrastructure problem would be solved in time. So I think when a lot of people think about AI at first, they think that it's something very immaterial. It's in a cloud, it's software. It feels kind of disembodied from everything else. But it's actually a very physical thing because it needs a ton of power to run, and it needs water for cooling, and it needs the buildings to be built for the servers to be in, and the chips and all that kind of stuff. So it's actually a very material thing. It doesn't feel that way because you put stuff in ChatGPT and you get an answer, but it's based on a very physical infrastructure behind it that powers it. And a year ago, when I looked at this problem, I thought that I was very skeptical about the infrastructure being able to keep up with the demands of this industry in general, with how power hungry it is, how hungry for chips, how hungry for servers, how hungry for buildings, how hungry for energy, etc., and water. If you were to ask me a year ago, I would have probably invested more on the infrastructure play than I would have on the AI traditional players like NVIDIA and Microsoft and these companies. I think the jury's still out on that. I mean, the market certainly has rewarded them. It's been a very good investment over the past year. I think the jury's still out, and we'll see whether, in fact, the development of this industry will bump against some of these physical infrastructure issues. I always joke that my PhD is useful maybe once every 10 years, but now it's starting to be every 5 years, maybe even more often, who knows? But understanding power is useful, understanding the power system and the grids and some of the bottlenecks and how it works. And it's very useful. So that's what made me a little skeptical of AI, but maybe I'm wrong. We'll see.
Yeah, it's clear it's all about power now. It really is. If someone wants to get into the nature and biodiversity investment space, how would you advise them to cut their teeth and get into the business?
There's two things. The first is I think it's really important to understand the nature of the problem. So when I first came into finance, I had a really good understanding of, as I mentioned, power markets, power systems, climate science, and all the issues around the intersection of climate and energy, etc. And so I came with this very deep expertise into a world that I didn't know that well, but turns out that my expertise was very useful. It allowed me to be the person in a room with 20 seasoned portfolio managers, but not really feeling intimidated by the fact that I was in this room with people that I thought, oh my God, they manage billions of dollars and whatnot, because I knew that nobody in that room knew about my topic more than I did. I was the expert on that. And they knew too, which is why they listened, and which is how I built my reputation. And then combining this expertise and what I knew with learning about what they knew, that gave me a very interesting profile that was quite rare. And so the idea is be curious. Become an expert at something. It's not enough to have just a high level understanding of 10 things. You should actually have a deep understanding of several things, actually, because you need to connect the dots, and it'll happen over time. But come into a role, don't be afraid of going into a bit of an uncomfortable territory, and come into roles where you might be the only person who understands some of the things you understand. That's actually really good for your career. That will really help you in your career. Obviously, you need a good manager and you need all those other things, but that's really important because it will make you feel like you have some power, even when you're a junior person just starting, but you have the power of knowledge and you have the power to add value to those conversations and to the work that's being done. So that's the advice that I give people.
Laura, it was really great talking to you. We've gotten to the finish line here, and I really appreciate it. I learned a lot. You've got amazing stories to tell and fascinating perspectives to share. So now tell everyone, what's the best way they can find out about all the great work you guys got going at NatureAlpha?
So the website is naturealpha.ai. You can find us there, and all the contact info will be there. And feel free also to contact me on LinkedIn. And LinkedIn, I think you also find my Substack, which is more a revolution. You have everything there, the podcast and Spotify as well. But yeah, naturealpha.ai to just get in touch with us about nature data.
Okay, everybody, go to naturealpha.ai. Lots of great information there. And then check out Laura's Moral Revolution podcast on Substack. And it's also out on all platforms.
Yes, Spotify and Apple Podcasts. Yeah.
All right. Laura, thanks again.
Thank you so much. It was a pleasure.
Goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.